Well, greetings to everybody. My guest this month for December is the formidable Alistair MacLeod, who is one of the great gurus on the subject of gold and precious metals and banks and all the other things. He is really a guide to the profession, if you will. He's much admired and listened to by people who are already professionals in the game, and I am one. And I post his stuff on my website. For those of you who follow my website will already see it. It's good stuff, and it's the only stuff you will get of the way he delivers it, and a strategic view. So if you haven't seen any of his work, get onto my website and you will see it. And of course, there's also a click onto Alistair's own website, and you can see all his stuff in its original form. I particularly want to ask him questions today that nobody is asking, because basically they don't really know how to ask them. You've got to qualify your questions first before you can get the answers. And if Alistair, if you could read at Oxford University Precious Metals, Alistair MacLeod would be a don. And so I'm going to treat him as a don, and I'm going to treat myself as a humble student. And he can answer these questions. And because he's so used to speaking to the profession, I know he won't mind if I pick him up every now and again if he uses a bit of jargon, which you won't understand. And in certain cases, I won't understand either. So I'm going to let it roll. We can't cover everything in one bite. Covered quite a lot with Claudio Grass out of Switzerland last month, as you know. If you haven't seen it, it's on my website. So I'm going to bowl them at him, and don't worry if I don't sort of complete the over, as it were, because he'll be coming hopefully back, and we can pick it up on other matters. So anyway, welcome again, Alistair. Welcome indeed. I would like to start, if I may, with banking and the international banking crisis. My audience will be banking with Halifax or Barclays or somewhere, comforted by the fact that there's a government guarantee if they go tits up, and they can claim their £80,000 or whatever the limit is these days from the government. And if you believe that, of course, we have banks like Lloyds Bank, for example, and I have a branch of that in Halifax, which is part of Lloyds Bank, who are far more interested in how many black customers they have and what their sexual predilections are in Pride Week, rather than banking. And perhaps if they look to their own level of banking and the important things that they're doing, I would suggest that they're not focusing on the right things. But that's really seems to me the way that modern banking is going. They don't seem to understand what I believe is a crisis coming, and we are on the edge of an abyss. So if you'd be so kind, Alistair, take it away. What's the banking situation today? What do we look out for? When's it all going to go wrong? Is it going to go wrong? So on and so forth.
All right. Well, before we go, can I just declare my interest? I'm head of research at Gold Money, which might make listeners, viewers think that I have a, if you like, a bias towards gold. I think it's true to say that those of us at Gold Money, our basic approach is, if you like, an argument in favor of sound money. It just so happens that legally money is gold. Anyway, having got that out of the way, as to your question about the banking system, I mean, there's several questions within your question. I mean, one is, why are they not paying attention to their customers? It is the job of any business to place the customer first. That doesn't happen in banking, I think, as in many other businesses, because they are very heavily regulated, and actually it's the regulator that comes first rather than the customer. So in that sense, I think that the banking system isn't really all that fit for purpose. As to the risks in banking, this is on two levels. I mean, we can understand perhaps that a bank gets itself overextended. You may not be aware that your bank is overextended. It may not be overextended. But nonetheless, history has shown runs on banks and things like that. So people don't actually take the security of their deposits in a bank for granted. A lot of them seem to think that the deposit in the bank is their money. No, it isn't. Actually, the money belongs to the bank. They just owe it to you. And it's a very, very important distinction. Governments try and get round this to create, if you like, the confidence in a banking system that doesn't lead to runs by having some sort of deposit insurance system in place, which they have particularly for the smaller depositors, which I think in this country is something like £85,000 or up to that level. But you've got to be very careful that if you split between one bank and another and so on and so forth, that one bank isn't a subsidiary of another because it all gets lumped together. So, you know, the little wrinkles like that, which you must be aware of. It hasn't been tested in the UK, and one wonders how long it would take in the event of a bank going under for depositors to be actually paid out by the bank, by the government. I mean, that's something which is yet to be tested. But there is another layer of risk in all this, and that is, since the central banks started indulging in quantitative easing, what has happened is that they have built massive bond portfolios, and those bond portfolios have lost value since they were acquired through quantitative easing. The result is that the notional capital on central banks, and it's not just the Bank of England, but the ECB, the Bank of Japan, also the Federal Reserve Bank, has been wiped out. So technically they're insolvent as well. Now, people will tell you that a central bank can't be insolvent because it could always print its way out of problems. Well, it can, but in a slightly different way from the way people think. It merely creates the credit, which it then extends, say, to its shareholder, which in most cases is the government. And that is then, if you like, reflected on the other side of the balance sheet, the liability side of the balance sheet. Instead of a deposit to the bank, a deposit from the bank to the government, it is reflected in equity. So that way you recapitalize it. It's just the magic of credit creation, which is really what banks do. So we've got a system, unfortunately, which is sort of theoretically insolvent, trying to rescue, in the event of a crisis, a commercial banking network. Now, it is the fundamental function of any central bank in this modern day and age, whether you agree with it or not, to ensure that the commercial banking system doesn't fail. That is its number one priority. So whenever you get a banking crisis, such as we had in America over liar loans and all the rest of it, and banks getting into trouble, they had to be bailed out. They failed to bail out Lehman. They decided to make an example of Lehman, which actually was a pretty stupid thing to do. Central banks need to protect the whole integrity of the system, and the danger of not doing so was actually shown by their failure to protect, to stop Lehman going under. So that, I think, is where we are. It's a question of, can the central banks in their current situation rescue or underwrite the whole of their relevant commercial banking networks without destroying the financial system? And the destruction of the financial system, if it comes, would be likely to be in the form of the credit of the central bank, which, of course, is reflected in the rating of the currency, because the currency is always issued by the central bank. So, I mean, in the event of the next banking crisis, with the way the structure has evolved, with central banks having enormous liabilities in excess of their equity on their balance sheets, this is likely to be a very, very different situation. Now, is it going to happen? Well, throughout history, we've had a cycle of bank credit, as any Austrian economist will tell you. I mean, they talk about the business cycle, but actually it's a cycle of credit. And when that cycle runs into a periodic crisis, which is roughly once every 10 years on average, and this one is long in the tooth, we're 13, 14 years since the last crisis, then it's actually quite sudden, rather nasty, and full of unexpected events. So the situation, I think, is that if you've got bank deposits, then you just got to pray that the Bank of England is sensible about this, decides to try and rescue everything. To hell with the currency. I mean, that's a separate problem for them, and doesn't try and indulge in silly things like, well, we'll try and bail in banks rather than bail out. Now, what do I mean by that? Well, a bailout, basically, we all know about. That's when the Bank of England comes in and underwrites a bank and ensures it doesn't go under. Rather like they did with Lloyd's last time and the Royal Bank of Scotland in particular. A bail-in is one where, according to Gordon Brown, who came up with this sort of wonderful idea at a G20 meeting in the wake of the Lehman crisis, was that the taxpayer shouldn't bear the burden of rescuing the banks. Therefore, it's got to have to be the existing shareholders and also the bondholders to protect the depositors. Now, as soon as, if any central bank utters a single phrase, just once, that, about bail-ins, large depositors, certainly, because they will have their deposits cannibalized into equity, but also bondholders in banks, they will run a mile. And so they will just bring about the collapse of the whole system if any central bank tries to go down that bail-in route. Now, it is a potential danger. I think it's important to bear in mind that in the wake of that G20 meeting, which Gordon Brown jumped up and down and sort of, showed that he rescued the world or had a major part in the rescue of the world, all the G20 nations have passed legislation authorizing the central bank to implement bail-in procedures. So we don't necessarily have a clear path towards a traditional underwriting of the whole banking system. I happen to think that central bankers are more sensible than that. It is the politicians who devised this thing at the G20, which was put in place effectively under the guidance of the Bank of International Settlements. That's the side that's gone wrong, but hopefully it won't be implemented. But there is, as to your point, Godfrey, there is a very substantial and increasing risk that these events are going to face us, I think, in the next, well, I mean, it could be a matter of months, maybe even less than a year, because there's so many things going on. I think, and we'll probably come onto this you might be interested to, if you like, develop this theme a little bit more, but the basic trend in interest rates, having been down from 1985 to last year, has now reversed, and it's now going in an upward direction. I'm not saying that we're going to immediately see 10% interest rates again or whatever from the central banks, but the general direction is absolutely clear. We have bottomed on the interest rate scene. So the question is, as far as the survivability of the banking system and as far as the risks for depositors are concerned, is how are banks going to deal with that change environment, having expanded massively their balance sheets on declining interest rates? They have now got a completely different set of risks to address, and that is going to be the interesting point from now on.
Tell me, Alistair, what is your view? And this is something which is very much outside the sphere of most people reading newspapers and watching TV, and even quite interested people watching this clip, certainly. The implications here of derivatives, which we can number debt, we can see debt, we can drill down forensically and find out what the debt is up to a point, and we know that's also beyond human imagination, certainly overall the world. Corporate debt, national debt, and private debt, I think 270 trillion we're looking at. And we're almost looking at sort of numbers that you expect to see, the sort of numbers if you're looking at the sky at night type of numbers, and a distant Neptune and stuff, which is beyond human imagination.
Absolutely.
Beyond human imagination. Yeah. And I'm in the business and I don't understand 270 trillion. But when it gets to things like derivatives, we're talking about quadrillions, which, is if trillions are above my imagination, quadrillions certainly are too, which of course, am I right in saying, is just another form of debt. And if that kicks off, how would it kick off? Will it kick off? Where are we with that? It sort of seems to be the elephant in the room that nobody dares talk about.
Yes, I'm sure you're right on that. The answer, I mean, you said, is it debt? Of course, it is debt. It's debt. It's credit. You know, credit is the other side of debt. You have to make a distinction, though, between two different types of over-the-counter derivative, which are quantified by the Bank of International Settlements. One is on things like interest rate swaps. The principal doesn't come into it at all. On an interest rate swap, it's merely the interest on a notional amount of principal. But where it does matter is in the case of foreign exchange swaps and forward transactions. In those cases, what's reflected on a bank balance sheet is only the supposed mark-to-market value of the contract, which is always a fraction of the total principal. It is the total principal that should be on the debt, because, on the balance sheet, because that is what is settled at the end of the day. That is the liability or the asset that a bank might have on its balance sheet, the total amount. And interestingly, I wrote about this in an article which I think which you may have put on your site. I think it was The Great Unwind 2, I mentioned it. I called the article. And I pointed out that foreign exchange forwards and swaps totaled around about 80 trillion. Now, the Bank of International Settlement actually released an article on this only 2 or 3 days ago, echoing exactly what I was saying, that you've got these notional amounts, which actually are not just notional, but they are the total liability, if you like, of entering into a swap or a forward agreement, which is not being reflected in the financial system in terms of on the balance sheets. This is, to use your phrase, the elephant in the room. And this is really where it is, rather than on interest rate swaps. That's, you know, there are different risks involved with that, but this is a major, major risk. So imagine for a moment that we have a reversal in the way in which the relationship, say, between the dollar and various other currencies occurs. And we have actually seen this recently. Well, what does this mean? This means that you've got something like $80 trillion worth, notional, but real at the end of the day, of foreign exchange forwards and swaps, which are profoundly affected by the change in trend. Now, the idea that it's all right, you know, it all balances out, actually isn't quite the case, because when these things become real, you find that the issue is, can the counterparty actually settle? And if the answer is no, you have got a problem. So this is major. So that I think is the point to bear in mind about these derivatives. The way in which this market arose, basically, it started in the mid-80s, and it started very, very gently, basically on the back of Big Bang in London. That was when suddenly, instead of you know, options and forward transactions being highly speculative things and to being always discouraged, I mean, it was sort of, you know, you and I will remember the stock exchange where you couldn't run an option for more than the 6 ensuing account was the word. You know, now we have, you know, you can run OTC options out for 5-10 years. I mean, you know, the whole thing changed overnight on Big Bang. And the result is that the whole of that derivatives market, which according to the Bank of International Settlements at the end of last year, was worth a notional $600 trillion, though it's probably a bit more than that. I wouldn't go into the quadrillions, but I mean, these are enormous sums. I mean, they're just, as you say, completely beyond one's imagination. It's grown like that on the back of this long-term trend of declining interest rates from Paul Volcker's 19.5% Fed funds rate in 1981 all the way down to zero in 2020, which it was stuck at zero for about a year. It even went negative in other countries, other jurisdictions, such as the ECB, such as the Bank of Japan, Switzerland, Denmark. I don't know, you know, all these currencies went into negative interest rates, which are completely unreal. I mean, you know, it shouldn't happen. So that was really what fueled the trend for the increase in over-the-counter derivatives. Now we have a new interest rate trend. What is going to happen to these derivatives in a rising interest rate trend? Well, logic tells me that the whole thing is going to go into reverse, and they're going to tend to contract. But when you get something contracting, it's then that you tend to have financial accidents. So I would say that this new trend of interest rates is likely to throw up some very interesting, to put it mildly, situations.
So you're using the word interesting in the Chinese sense, really, Alistair, aren't you?
Yes. May you live in interesting times.
May you live in interesting times, yes. It seems to me, just reversing that to interesting on the bail-in, the bail-out, which I have been talking to my followers about, and explain just what it is and how it works and so on and so forth. And I use the analogy about getting back to China, that, you know, the banks would issue pieces of paper which wouldn't even be as beautifully written as those useless Chinese bonds which people now collect.
Yeah.
But it seems to me that the end result would be exactly the same, because it doesn't matter if it's a bail-in and they're going to give you worthless paper. If it's a bailout, they have to print it, which gives you worthless paper. So you end up at the end of the day with worthless paper. It doesn't matter whether it's a bond that the bank's issued, or it's a banker's, or it's a note, a £10 note or £20 note or £100 note from the Bank of England. It's the same thing. It's useless paper.
Yeah, in theory, you are right. But I think I draw a distinction between the worthless paper of a bank deposit and the worthless paper issued by a central bank. People, I think, are more inclined to accept the value of a bank's worthless paper in the form of a deposit than they are to not question, if you like, the value of a central bank bit of paper. I think if they see a central bank going crazy with issuing paper, then the effect on their behavior as consumers is a lot more sharp. What I mean by that is that they will adjust the relationship between their cash liquidity and the goods and things they purchase more rapidly when they see a debasement of central bank credit as opposed to commercial bank credit. And there's so many instances of this throughout history. I mean, and we've seen, and particularly in the 19th century, when you had, again, the cycle of expansion and contraction of commercial bank credit, the business cycle driven by the credit cycle, the bank credit cycle, we had all that. I mean, when things settled down and the whole system became more slick, with central clearing and the Bank of England joining the central clearing system in, I think it was in 1868, what you found was that you would get big variations in the levels of commercial bank credit, but at the price level, the effect actually was pretty minimal, because people were confident that so long as they could exchange a £1 note for a sovereign coin at the Bank of England, it really didn't matter. They were quite happy to hold on to any excess cash rather than rush out and spend it. And today we see this in Japan. I mean, the reason that you don't have price inflation reflected in Japan quite as much as we see in the West is because when the Bank of Japan prints money, or the banks increase the amount of credit, it just goes into people's savings and it gets recycled that way into investment rather than immediately spent on consumption, driving up the prices of consumer goods. It's the behavior of people, really, I think, more than anything else, that sets the purchasing power of a currency. And this is why I think they're so much more sensitive to what a central bank does than what the banking system as a whole itself does, because they don't actually understand bank credit. But the one thing they can see, which is in your face, is what the central bank is doing. That, I think, is far more obvious. And it's particularly more obvious in the foreign exchanges, which are always the first sign of the loss, if you like, of purchasing power of currency. It is, if you like, the market sign that this is actually what is happening to a currency. Forget the CPI. That's a load of rubbish.
It's interesting. Yes, because as Austrian schools, fellow Austrian school economists as we are, it's Mises' famous phrase, isn't it? It's human action. It's
Yes.
human action.
Yeah.
What is interesting, though, and I hadn't picked up on this, I knew it'd be interesting talking to you, that we all know that Japan is different, don't we? It was the old saying in the city, wasn't it, in our time? It was, oh, Japan's different. It's different in Japan, you know, and clearly it is. Of course, the other Austrian school economic hypothesis, of course, is the crack-up boom. Now, it's only anecdotal, and I can't put my finger on it, and it's very difficult at this stage, but one needs to sort of sniff the wind a little bit. I'm sniffing the wind to see, there seems to be a crack-up boom going on at the moment, but that's only anecdotal, really, where people, you can't save money, there's no point in saving money. We have inflation, we don't have hyperinflation, but we do have quite serious inflation. So people know there's no point in saving for tomorrow. Saving, therefore, in the West is weak. Diabolical in America, diabolical in Britain, not that good in Western Europe. So saving isn't per se what people have been doing. Whole new program on that, Alistair, if we want to talk about the welfare state and all the way. Leaving that aside, that means that we could see that. Interesting to see how we can monitor that. And as I say, it's only anecdotal at the moment. That probably varies. But if you go to, I was in London the other day, I don't go to London much, but it doesn't look to me like anybody at all is actually concerned about anything. You know, the spending is spending is spending. They're paying £5 for a pint of bitter, which wouldn't get you very far in Yorkshire, where I live, I can tell you. They moan at £3.10. And I'm one of the moaners because I'm a miserable Yorkshire bastard myself. Yeah, the restaurants are full and all this kind of thing. But it's clear, I don't know what the historical analogy might be, but it's almost, I suppose you might add that, you know, the Roaring Twenties pre-depression, perhaps, I don't know, where everybody's partying, everybody's having fun, nobody seems to take any notice of the future. And when I talk to my nephew, who's a name at Lloyd's, and his young chums, about 30, going places, bright as you like, I'll take you out for a few beers one day down there in Leadenhall Market with these guys. They're fun guys, you know. Yeah. But they have no concept of what's really going on at all, you know. It's just fairyland. They're earning monster. They've got glamorous girlfriends. Everything's absolutely marvelous, but they think everything's great. They think this can never end. You know, another analogy might be, of course, in the late Edwardian era, before the Great War, for the aristocracy, certainly, where everything was marvelous. I'd like to finish on another question, Alistair, and lots of other things to talk about, but we'll talk about those another day, hopefully, if you can find time. One of the great quests historically was it not, alchemy, trying to turn base metals into gold, which we have not yet managed to do. But what we have done, which is fascinating, and if you could explain this a little bit, because I've had a lot of questions on this, how we've managed to change gold, real gold, lumps of gold, into paper, which is a fascinating reversal of this concept. So what people are struggling with, and I can understand it, it's a really fourth dimensional view, is how lumps of gold or gold coins, of which there are almost none left. You know, there isn't much of that left now. It's very difficult to get hold of. And silver is the same, but that's another conversation, silver again. But talking about gold, how is it that the banks and Wall Street and bullion banks can actually trade in this paper, which is meaningless, but still affects somehow the price of the lump of metal or the coin? And if I may use one perhaps analogy, which I was thinking when I was walking the dogs, which might be crazy, I don't know, I haven't thought it fully through. That's, imagine a market stall, a market day, let's say Borough Market, and you've got somebody selling very expensive fish over here, Dover sole, which is very expensive. Let's say it's £30 or £40 a kilo, whatever it is, damned expensive, I know, over here. And somebody who's selling cod on another fishmonger's slab, and he's actually calling it Dover sole, and everybody knows it's cod, and he's selling it for a few quid cheaper than the Dover sole guy. And it's still controlling the price that the guy can charge for his Dover sole over here, because he's selling cod over here at a discount. And that, it seems to me, they're selling paper at a massive discount. It's bullshit. And I worked out in the book, and you very helpfully contributed, if you remember, to a chapter in my book, Magic of Banking, plug, on some of these matters, and I thank you for it. How does that, I think we've got 500 pieces of paper for each piece of gold. And that's just a sort of a bit of a guess, but it's all guesswork at the moment. But certainly it's not far away from that figure. Now, here's the question. I asked this of a gold bullion dealer 10 years ago. I said, how much longer can this crime, I can't think of another, it's a crime, how can this be allowed to continue? How can it continue before the gaff is blown, as it were? And he looked at me, very intelligent guy for a bullion dealer. One of the sharpest pencils, let's be honest. This guy is, and he said, a very long time, Godfrey. That was 11 or 12 years ago.
Well, he's
right, wasn't he? He was right. A very long time. Tell us all, tell the audience here, how can this continue to go on?
Right. Well, I'll start with a little bit of history on this. And this was confirmed by Peter Hambro not so long ago, because he was in on the beginning of this in the 1980s, I think probably in the late 1970s, when the Americans had obviously failed to suppress the price of gold. They did not want to see gold as a rival to their ambition that the dollar would become the reserve currency for all the other currencies, and that gold would be sidelined in the whole system. What they decided to do was to come up with the means whereby they would divert demand for the metal into paper. And they did this by creating the unallocated bullion account system in the bullion banks in London. And this is why the LBMA business just took off. And when they first produced statistics, nobody could believe the size, the quantity of these derivatives. I mean, because if you have an unallocated gold account at a bank, really what that means is that it's not backed by gold. It is a derivative of gold, just the same as a forward or a swap or whatever. It is a derivative of gold because it is not gold. And what it did was it just soaked up demand. They'd also used this to soak up demand in other things like silver, copper, other metals, and so on. So that was the basis of it. And it was a policy which really followed all the way through, certainly until fairly recently. And I would guess that it is still, if you like, in the background, a policy. But what has changed in all this is a slow burning fuse of demand from the East. Basically, the Chinese have cleaned us out. And the Indians have done that to an extent as well. And then, through the this wonderful policy of trying to sanction Russia finding its foreign reserves in the form of dollars, euros, whatever, are now completely valueless because they've got no access to the system. They're now cleaning us out of gold as well. So you can see that the West suddenly has got virtually no gold whatsoever. And they're still trying to suppress the price, but it's working in a slightly different way, because what the bullion banks are doing is they're short. This is always the way they've run it. They're always short of paper. They're always on the short side. It is speculators who go into the market, hedge funds who just do a simple trade. If they think the dollar's going down, they sell dollar, buy gold. If they think the dollar's going up, they sell gold, buy dollar. They're never interested in taking delivery. But the result of this is that the bullion banks are always on the short side. And they're trying to close their shorts because they can see what's happening. We see that the Bank of International Settlements, which is sort of acts as a liquidity provider in the market to keep this whole scam going, they have now closed their short positions. I mean, the last I saw, they closed it down from something like 350, 400 tons down to 7 tons. And that was in October, I think. So, yeah, I mean, this intervention thing is more or less coming to an end. But that's the basis of it. The whole thing was to just take demand, real demand for gold out of the system and absorb it in the form of useless paper. And so it's a Ponzi scheme, which I think is finally coming to some sort of end. And the thing that's doing it is the change in interest rate trends. they're being driven by suddenly rising prices getting out of control, the product of all the monetary expansion, particularly over COVID, and the effect of sanctions has really transformed that monetary expansion into prices for energy, prices for food, these vital things. These vital things, which I can tell you in this winter, are going to be so unsettling to the Western alliance. This idea that the Europeans just go along without question with American foreign policy, that is now going to become increasingly exposed as being completely wrong. And I think that the potential for unrest in Europe, I think, is great. I think the potential for a banking failure, which will have to be rescued by a bankrupt ECB, is just escalating by the day. There is another thing. If you look at the liquidity, sorry, if I can go back to banks just a little bit, Godfrey. In America, the banks have plenty of liquidity. They have there's something like $2 trillion in reverse repos at the Fed, a bit over 2 trillion. Now, just to explain that, a reverse repo is offered by the Fed into the market for people who have too much liquidity. It takes money out of circulation onto the Fed's balance sheet. It is then no longer in public circulation. That can be removed back into public circulation simply by not renewing the repo. This is voluntary. It's the banking system saying we've got too much currency and credit in our system. Our balance sheets are not big enough to take it, so we're going to park it at the Fed so that that it's nice and safe, and we can comply with all the regulations. Fine. But when you look at it the other way, we're then talking about repos. Now, a repo occurs between a commercial bank and a central bank when the commercial bank requires liquidity. Now, in Europe, the level of repos is something like 5 or 6 trillion euros. So they've got completely the opposite situation. Now, what happens if the cost of doing a repo, which is basically tied to the ECB's interest rates, starts rising? Well, the answer is that liquidity becomes more and more expensive and less available. And the other thing that goes with it is increasing counterparty risk. So you find that the liquidity in the repo market starts drying up. So we have a problem developing in Europe, which is likely to unsettle the whole banking system. And bearing in mind that banks like Deutsche Bank have asset to equity ratios in excess of 20 times, which is extraordinarily risky. It really is. It's top of every banking cycle we've ever seen. It's not just Deutsche Bank, Crédit Agricole, BNP. I mean, all these Eurozone banks are very highly leveraged. So what are they doing? They're trying to contract their balance sheets. And one of the ways in which they contract their balance sheet, coming back to your question about gold, is that they have to reduce their exposure to derivatives. So we're talking about commodity derivatives, we're talking about trading in the markets and so on. So liquidity in all these things is drying up. So what we are beginning to see is not just, if you like, a little bit of local difficulty in terms of liquidity in the paper markets for gold and silver, which is definitely the case now. But what we're beginning to see is a complete withdrawal beginning of the banking system from supporting the system that was put in place way back in the early 80s, maybe late 70s, which Peter Hambro referred to when he was talking about the creation of unallocated accounts. Those unallocated accounts backed by nothing. The banks are offering them even short on COMEX and presumably short also in the London bullion market because of the lack of liquidity in the real, in the underlying bullion. All that has got to be wound up. It's got to be closed down, because if they don't do it, the banks are bust. They are already bust from other points of view, but you can see that this is yet another risk as far as the banking system is concerned. So the whole thing is being unwound. So I think that what we're likely to see at some stage in the near future is the ending of what your very intelligent friend in the bullion bank said that it would go on and on and on for longer than you can possibly think. I think we're beginning to get to that point. And we'll probably have it, well, I mean, a banking crisis will certainly trigger it very, very rapidly. So I think it's coming to an end.
Well, thank you very much for all that, Alistair. Actually, this could, of course, go on all afternoon.
You could.
But what I'd like to do is bring you back again, if I may, because there's still lots and lots of things to talk about, which are fascinating. We are living in interesting times. There's no question about it, which is not, of course, all good. But thank you for that. And for any of you watching, my Q&A thing is going to go on rolling. So if you've got a question about this particular interview, everybody, please let me know. If I don't know the answer, I can bet your bottom dollar that Alistair will, and I'll pass the question on to him.
But I might have an opinion rather than an answer.
Well, I was just going to make one caveat: timing. None of us ever answer a question on timing.
No.
We know things are going to happen, but we don't know when. Otherwise, Alistair and I would be somewhere warmer than we are at the moment, I suspect, on a yacht. Anyway, thank you again.
I can say as an ex-stockbroker, I would agree with that entirely. having tried to make predictions in the past and failed miserably.
Timing is everything.
Timing is everything.
Thank you again.
Absolutely.
Thank you again, Alistair.
That was my pleasure, Godfrey. Thank you for asking me.
As most of you know, my work is very heavily independently research-based. And I get my information from all over the world. It would help if you press the subscribe button and the little bell next to it, because the more subscribers I have, the more likely it is that international independent research institutes will share their material with me. It's most helpful, and then of course I automatically share it with you. So, surprise, won't cost you anything. Thank you very much.